mortgage rates inch closer to 7% this week, reaching 6.9% as of Friday. That's up significantly from start of the month, and it's keeping both home buyers and refinancers on edge. So what's next? Are we finally hitting a plateau, or is there a more upward momentum ahead? Let's dive into what drove rates higher this week and what's on the horizon. October has been a turbulent month, with mortgage rates rising consistently and mortgage applications plunging week after week. The mortgage applications dropped another 6.7% from last week, with purchase applications down over 5% and refinance applications falling by more than 8%. These declines reflect not only high rates but also the ongoing uncertainty around Fed's policies, and compounded by strong economic data and the election uncertainty, with some polls and betting markets showing a higher probability of a red wave. First, let's take a look at what happened this past week, and then we'll review what does the upcoming week look like. On Monday, October 21st, mortgage rates rose from 6.68% to 6.82%. They continued climbing on Tuesday to 6.85% and then jumped again on Wednesday. Finally, on Thursday, October the 24th, we saw a slight breather, with rates dipping down to 6.91%, and by Friday they settled at 6.90%. Despite this minor pause, rates remain close to the 7% mark. This brief pause could indicate rates may be leveling off, but with critical economic data on the way and the added volatility as we approach election week, it's uncertain if this stability will hold off or more fluctuations are coming. Starting with housing stats came in at 1.54 million, just above the forecast of 1.35 million, but slightly down from last month's 1.356 million. Building permits, however, dropped to 1.428 million, missing the forecast of 1.46 million and down from 1.47 million previously. A slight uptick in housing starts show builders are still active, but the decline in building permits suggests that they are cautious about future demand given the high mortgage rates. This could keep housing inventory tight, potentially supporting prices even if demand cools. Mortgage demand dropped significantly, with the MBA refinance application index down to 672.6 from 734.6 the previous week. Existing home sales also slipped to 3.84 million, below the forecast of 3.9 million and down from 3.88 million last month. These declines reflect how high mortgage rates are impacting both refinancers and home buyers, as fewer people can afford or justify taking out new loans or refinancing at current rates. This reduced demand puts pressure on the housing market, slowing overall activity. In employment, jobless claims came in at 227,000, lower than the expected 242,000. Meanwhile, continued claims rose to 1.897 million, above the forecast of 1.88 million and up from 1.869 million the previous week. Lower than expected jobless claims signal a strong job market, but the rise in continued claims hints at a slight increase in long-term unemployment. This mixed picture suggests some resilience, which keeps inflationary pressures alive, affecting mortgage rates. The S&P Services PMI, which tracks activity in the services sector, came in at 55.3, above the forecast of 55. The manufacturing PMI also rose slightly to 47.8, beating the 47.5 forecast. A stronger services sector indicates the consumer demand remains steady, which could keep economic growth elevated. In contrast, the manufacturing sector is still contracting. This mix of strength and weakness adds to the uncertainty, which can keep rates volatile. All right, here's what's coming up this week and why it matters for mortgage rates. On Tuesday, we'll get the consumer confidence report and the jobs opening report for September. This is big because if confidence is high and job openings are strong, it could keep pressure on rates. Then we have a packed Wednesday. We'll see the ADP employment report alongside third quarter GDP report. If these numbers are strong, it might reinforce the high rates we are seeing now, as strong job market often means the economy is humming along at a pace that keeps inflationary pressures up. Moving on, Thursday, it's all about PCE index, the Fed's preferred measure of inflation. If we see this index holding high, it could push the Fed to stay aggressive, possibly keeping these rates elevated. Finally, on Friday, we have a big one, October's employment report. If job growth is strong here, rates might edge higher as markets interpret it as a sign of resilient economy. But if the report shows a dip in jobs, we could see a change in momentum finally, which could offer some relief for mortgage rates. With rates at their current highs and economic data hinting that inflation may not be slowing down enough, mortgage seekers have a tricky decision. Locking in now could be a safer option if you are concerned about future rate hikes. However, if we start to see signs of economic slowdown, a dip could be possible, especially in the weeks ahead. As a buyer or refinancer, this is a time to stay informed on the latest data. Next week's reports, especially Thursday's PCE index and Friday's employment numbers, could significantly impact mortgage rates. If they point to continued economic strength, we might see rates climb further. But if we get any signs of slowing, especially in job growth, rates could stabilize or even dip slightly. Either way, staying informed will be crucial for timing your mortgage decisions. With so much happening, make sure to hit that subscribe button and turn on your notifications so you never miss an update on mortgage rates and housing market trends. And let me know in the comments, do you think rates will continue rising, or could we see a break soon? I would love to hear from you and what your predictions are. And if there's a specific topic or current event you would like to dive deeper into, drop that in the comments as well, and I'd be happy to make a video on it. Thanks for watching.